Hey investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Zillow. Zillow reported last week on Thursday their Q4 results, and the stock is down substantially in the past 12 months. Um, Initially, the stock did kind of rally meaningfully after hours, but then it just ended up being up approximately 10% during the day. Now, I think that there's a lot here that's worth unpicking. I think that this is quite a compelling investment. So, just a 2 second reminder, Zillow had its home segment, which is iBuying, and that didn't work out. It made a move for that, and it just didn't work out. The stock reacted very negatively. They're going to exit this business in the next 2 quarters. So what you have to consider here is just its IMT segment. IMT stands for Internet Media and Technology, and it's basically an advertising business. Okay, let's forget about for now the Zillow's mortgages segment. Just focus on this IMT segment. Okay, so with all that, just the IMT segment, I make the case that it's priced at approximately 14 times EBITDA or 17 times free cash flow. So let's go through that and kind of understand what's at play here. So as already alluded to in the introduction, the stock, even with the little tiny little pop at the end, the stock is down more than 70% in the past 12 months. And it's been brutal, right? There's no getting around that. So for any shareholder that's invested in Zillow in the past 12 months, you are just in your frame of mind, I need to get out of this stock at any cost. And particularly when they announced that they were finally giving up on their iBuying segment, the stock just went poof. And it was like the capitulation. Everyone's just like, okay, enough of this. Uh, but for anyone that's kind of held on to it, as the stock starts to appreciate, they will just be wanting to kind of break even. Break even. It's really important to kind of, break even. And when that comes, there's going to be a lot of volatility in the stock. And so it's not going to be an easy investment. There's absolutely no way that it's going to be an easy one. Okay, so what's actually happening here is Zillow doesn't make it easy for shareholders. I know they tried, but I mean, they just really missed the mark here. So they say, okay, here's our revenues, and you can see here the revenues are really, really strong. And Q1, it's supposed to be up 182% year over year, okay? But that's because it's still including the home segment. So without the home segment, if you're just looking at the actual IMT segment, the business is growing meaningfully slower, and this is going to confuse a lot of people over the next several quarters. So they could have gone out just clean and just made it really simple for everyone to understand. Okay, this is the ongoing business, and just made it easier because they ultimately need new investors to come in and appreciate and understand the story. And unless you're kind of really entrenched in the business, if you're an analyst who on the sell side, it's going to be difficult for people. And I think that that's one of the yet another way that they've mishandled the situation. Anyway, moving on. So going forward, this is more or less what you're going to have. You're going to have the IMT segments, approximately 90% of the business, and then you're going to have the mortgage segment. So I've given actually no weight to this mortgage segment. In a previous article of mine, I estimated that it's worth approximately 1 time sales, but just giving it nothing today. Let's just forget about this, throw it in the bin. So what you have here is a business, the IMT segment, the advertising segment, has really compelling margins. Okay, so you can see that since 2018, the EBITDA margins of this business has grown from 20% EBITDA and ended 2021 at 45%. Now, that's at the high end, and they're going to be kind of investing for growth. So it's not going to be so high going into Q1 2022, but for all intents and purposes, this is in line with what they've guided. They've guided for approximately 2025, when they finish 2025, the year 2025, that they're going to have approximately 45% EBITDA margins on the IMT segment, okay? So let's use this kind of roundabout 40 to 45%, somewhere around in the ballpark. That's the number you need to think about. What is kind of more difficult to get our heads around is that they're talking about growing their revenues by approximately 24% compounded annual growth rates into 2025. Now, looking back, the IMT segment, which is the core of the business, has grown at approximately 57%. You can see there, 57% since 2018. So it's kind of in the ballpark of 12% compounded. So how does a business go from 12% compounded to 24% compounded annual growth rates? They try to kind of explain it on the call. I'm a reasonable investor, and I was like, yeah, I don't know. How do you give any credence to this? It's kind of difficult. If you have historically grown at a certain rate, how will you also? And you know what? I'm gonna double that rate of return. Like, I mean, I don't know. Particularly the guidance for Q1 is pointing to approximately 9% growth. So it's actually worse than it has been. I know that there was this kind of pull forward during 2021, when the advertising was quite strong for them. And you could say that, as it lapsed that, it's kind of difficult for them, but for all intents and purposes, it's quite difficult. So I've kind of estimated that it kind of grows at 10%. I've said that, okay, forget what they're telling me, let's just use 10% here. Now, so if you look through here, look at the 10K that came out on Friday, and I was looking through here. So if you look at the adjusted EBITDA, you have negative 650 million coming from its home segment. This home segment is going to be unwound over the next 2 quarters. They talk about that being cash flow break even, cash flow positive on a break even line. So I'm just put aside as well the mortgages, and you just left with the IMT segment. The IMT segment made approximately 850 million of EBITDA. Now, I estimate that if this was to grow at approximately 10%, okay, you're kind of in the ballpark of 940 million of EBITDA for 2022 for the IMT segment, okay? So this kind of looks quite reasonable. If you look at the SEC filings, you can see that their capex is approximately around 100 million, okay? But that would include them investing in the iBuying segment. If you think about that, they're not going to be investing on the iBuy segment, they'll just be investing on the advertising business. I don't think that the capex will meaningfully increase. It might even decrease because they only have one segment to focus on. But let's just use that same 100 million just for simplicity. That points at approximately free cash flows of being around 840 million. Now, at 840 million, that puts the stock price at approximately 17 times this year's free cash flow. In a previous article of mine, I estimated that Zillow could grow at 15% compounded annual growth rates, but since management is saying, okay, we're growing at 24, but then at the same time they're guiding for 9%, I've kind of just settled on 10%. I've just kind of downwards revised my own estimate, and this still kind of comes around you paying 17 times free cash flow for high quality business that hasn't got a lot of capex requirement and is expected to grow in the double digits. So I think that's pretty reasonable in this market. I mean, there's a lot of companies out there where you pay 17 times forward sales, and it's like they're growing approximately 20%. So they are growing slightly slower by my estimates, but they're already making the free cash flow. That's ultimately what you want as an investor in the business. So in the past, in the past 12 months, the stock is down meaningfully, and it means that over the last 3 years, investors that are invested in Zillow, you've gone nowhere. There's no one here that's pounding their table saying buy Zillow this price. Probably there's some people that kind of like to buy the falling knife and stuff, but for all intents and purposes, institutions, which really what moved the needle, no one's really going to be pounding the table to buy here. So I think this is interesting. I think that persons shouldn't try and kind of go too aggressive and try and buy the dip. Just kind of, I think it's important to be quite slow and steady. Slow and steady wins the race. Try and kind of just don't put yourself in a position where you become overwhelmed, essentially. Put yourself in a position that if this falls another 50%, you're going to be content to withstand that, because you want to be aligned with yourself, with your businesses, the businesses that you like, that suit your temperament, and businesses that if it sucks that it's down 50%, you can put up with that. You're not going to be edgy and stuff. So anyway, if you want to find out what other names I'm looking at right now, don't forget to check out my marketplace. It's called Deep Value Returns, and yeah, drop me a line, check out the reviews, what other people have said. I help you by offering you high quality investment insights. Okay, thank you so much for listening. Good luck throughout the earnings season. Bye bye, see you soon.